Let's talk a little bit about this concept of overfunding companies. It happens every 5, 10 years. New entrants come in, venture tourist Doug. They start dumping money on top of companies that we've really been thoughtful about building. And founders, of course, look at it and go, "Hey, Doug, Gilly, I've been offered this crazy, check with no board seat, no information rights. I've never heard of this firm, or maybe they do public stocks and now they're dipping into privates." And that created quite an overhang in the SaaS space. Yeah, Gilly, like where we had maybe companies get overfunded. And then you have, some members of the board who invested at, $2 billion and the other ones invested at 200 million. And the companies in between those two sort of realities. And then it becomes a lot of hand wringing and pain, and suffering. Maybe where are we at in that part of the cycle, Gilly? It seems like people are getting super excited again just this year.
Yeah, my view is that the venture business is a complex business. And if it was easy, then everyone would do that. So the some of the complexity is to keep the balance between the need for speed and then not, throwing too much money on a company. And that's a fine balance because my experience is that in order to build a large, important, sustainable business, definitely in cybersecurity, which is my focus, that's an expensive exercise. It's expensive. You need to build massive amount of code and products, army of people to sell and support the product. It's an expensive exercise, so money and sufficient capital for the company early on. That's really important.
Doug, we've seen this movie over and over again.
So you're going to find my answer sarcastic. First of all, the sham of the scam that is called venture capital. Let's take a look at this. We get paid, we raise money for which we get paid fees for the pleasure of investing the money. If we lose the money, so what? And if we make money, we get to keep somewhere between 20 and 30%. You wonder why the balance between greed and fear always lean towards greed. A much more fair view would be here's the money, no fees, and you have to match dollar for dollar what you raise with your own money. Now you would see the greed and fear balance. So already you have this proclivity to lean in because of the compensation structure. Point one. Point two, we have seen every generation. And by the way, I know my partners, or certainly in Sequoia Marketing, won't be happy that I said all that, but who cares? I'm old enough that I can say that. Second, we've seen every wave to be stronger and stronger. If we just look at the internet wave, 1995, when Netscape goes public, 1999, two great companies get built. Then, oh my God, the internet is a fraud. 9, 10 years, death, and then here we go again. Mobile, there wasn't a 10-year gap. There was a 2 to 3 or 4 year gap between the head fake and reality. And I think AI is going to give us even a smaller head fake. So I think the opportunity in front of us is huge. So you have a proclivity to lean in by the money, and the fact that we know each wave is bigger, is quicker and quicker and bigger. And so I think we're in for quite a show, actually. And the trick is to pick them, though, right? Because if you invest in everything, you're going to get nailed. And so, like everything else, it's a pick 'em business. And we do know that if you pick 'em right, chances are it doesn't matter which round you came in. But I'd also urge all your listeners to think about all the dead FMV, all the dead companies that exist. Think about the thousands of companies that have revenue run rates 30 million grown to 33 million, who are being carried on their books maybe at 120 million value, and they're really worth nothing.
Mm.
And so as you think about leaning in and doing something silly like some venture investor did 4 years ago, I won't name any names, who had a theme investing in everything, you're going to get nailed. And so there's all these great forces, and the trick is just being the right one. There's 2 or 3 or 4 investments a year that matter, and being those, and you'll do just fine.
One of the themes we talk about over and over again on This Week in Startups is making sure you do your chores. I'm no expert on these things. I have some experience. Stephen Estes from CLA is an expert. Let's talk about being cash efficient. Tell us about efficiency and what you see in the top tier startups in your practice.
We're seeing kind of an interesting trend out there where companies aren't needing to raise quite as much as they had in the past. You really have to be careful as a founder to only take on as much money as you really need. You got to do the forecasting, you got to do the modeling, and you got to dial it in and get it right. Otherwise, you're going to end up either not raising enough capital to get to where you're going, and you're going to have to go get venture debt or go back, have an extender to the round, or you're going to give up too much of the company because you just didn't recognize how much money you actually needed.
Yeah, very important to get this stuff right, folks. And that's really a bummer when startups don't do things in a button-up way. Always have a great partner, a good partner to have on this adventure while things change. My friend Stephen over at CLA. Visit CLAconnect.com/tech. And don't forget to mention that your boy JCal sent you. That's CLAconnect.com/tech. Start today.